Welcome back to another edition of Beyond the Waypoint with my co-pilot, Skylar Martin from Maximum Wealth. My name is Benton Blake, Rise Wealth Management and Planning. And Skylar, today, I think we're talking about a very fun topic, insurance.
Yeah, it's funny. Most people wouldn't call that a fun topic, but when you're an advisor, weird things are now considered fun, like taxes and insurance. So yeah, I'm excited to jump into this one.
Sweet. Well, yeah, with life insurance, it comes up as it should. Anytime we meet with a client, it's like one of those things when you build a financial plan, it's like one of the first things that should be addressed, because if not, it tends to get missed. But why is it even worth talking about? Why do we bring it up?
Yeah, that's a good question. And I tell every client this, at least new client, like, look, I start with our protection strategy meeting where we're covering things like insurance, workplace benefits, estate planning. And the reason I start with something like insurance is because it's often the most overlooked. Like, this is the area where people are usually not thinking about. A lot of times people are investing, saving in some capacity, but they don't even think about insurance. And I want to make sure that we cover that, because the thing is, if I can go ahead and build a great investment strategy for you, a wonderful cash flow plan, we can get everything going into the right accounts, that's great. But if the catastrophic were to happen, none of that matters, right? And so I want to make sure that we cover this from the outset, because that is really the foundation for everything else that we're building. And so, yeah, we talk about it because of those reasons. Like, if something catastrophic were to happen, like a premature death, it can derail the financial plan for your loved ones. That's really what we're talking about, is protecting the people that you love most,
Yeah.
And so for your family, that's, it's going to be your family, right? Your wife and children, or your husband and children. So that's why I start with it and why it's worth talking about.
And yeah, imagine, so when we build these financial plans for clients, we reverse engineer from excess cash flow where we can put that money to make the plan successful. But that cash flow is key. So if you lose that, is the plan still successful? Right. And yeah, imagine building the dopest plan ever for a client. Hey, you can retire at 45, and then next, a year later, the unfortunate happens. And now all of a sudden, not only can they not retire, but, at 45, you're looking at working until, like, for the wife going back to work, or the husband going back to work, working till 65. Like, it can blow up a full financial plan. So,
yep, exactly. And so that's why, like, when we're talking about insurance, like you mentioned, cash flow is important, right? That's really what makes or breaks a financial plan. I could retire right now if I only spent $1 a month for the rest of my life, right? Cash flow is what makes or breaks a financial plan. So when it comes to life insurance, we're looking at a few things. One of those being income replacement. In a lot of scenarios, we have two earners, okay? And so if one were to pass, that might cut the household income in half. And then now we're saying, okay, there's might be a lifestyle change that has to happen with that. Or there's one person who is the primary breadwinner. And if that person were to pass, the other one is in a scenario where I got to go back to work. I got to try to find a job. Maybe we have young kids. How does this affect them? And it really adds a ton of extra stress to a time that's already, think about it from an emotional perspective as well. This is already probably the hardest thing you've ever gone through. And then on top of that, you don't have enough money to pay the bills. That's just an added layer of stress that can be mitigated through this kind of insurance plan.
Yeah. Yeah. You mentioned replace income for, like, living expenses, gas, groceries, entertainment, lifestyle. Then there's you and your wife just bought a house.
Yep.
Right.
Yeah.
And so, yeah, good luck living off of, $1 a month when you have a mortgage to pay. Right. So there's this other aspect that life insurance needs to help support.
Exactly. So no, you're right. And we'll look at that. We'll say, okay, so we have a mortgage, maybe a car payment. For some people, it's like, hey, I've got 3 kids and I've been planning on paying for all of them to go to college. All of those factors come into consideration. And so we'll say, okay, so let's say you're to pass tomorrow. What do we need to pay off or cover in order for you to be able to continue to reach those goals that are so important to you? Right. And so for some, that might be, I'm going to pay off the mortgage so that my spouse doesn't have to worry about having a roof over their head. Right. That's often a big one. Maybe it's childcare. Okay, I know that my spouse might have to go back to work, so we're going to have some kind of childcare for the kids. Maybe it's college, right? Those are the conversations that we're having to help us understand, okay, how much do we need as far as insurance goes?
Yeah, no, that's a great point. In that, when you're young, you think, I don't have a lot of expenses. My lifestyle hasn't become so extravagant that I need this huge life insurance policy. But when you start looking at what liabilities they may have with the student loans and the high mortgage, because they just bought the house, right? That's where you may need it more than, because you can cut back on living expenses. You can't cut back on your liabilities.
Exactly. And so like personally, my wife and I got married almost 4 years ago. I got a life insurance policy immediately. It was, a smaller one than I have now. And that brings me to now. We just bought a new home. Mortgage is a little bit bigger. We had our first baby this year. So our life is becoming more complex. We have some more liabilities. We have some more expenses. And so I went and I got another policy to help protect my wife and my daughter if something were to happen to me, right? And so these conversations, it helps in these conversations because I can say, hey, look, this is what I'm doing. I'm not recommending anything that I wouldn't do for my own family and my own financial plan.
Yeah. And if you have kids and younger, it's funny, you may need insurance more than when you're older and you have built up a good net worth to where maybe that can be your insurance policy. But, jumping the gun on there, we've established a need for insurance with our clients. We've sat down and said, okay, we need clients. And we see all over the internet mixed reviews on insurance. Yeah. Financial advisors just want to sling insurance. But then you have financial advisors that criticize insurance themselves. It's like, but wait, I thought that's what you sold. So a lot of misconceptions with insurance. How do you determine, let's break down, what are the two main kinds of life insurance policies? And how do you determine what kind of insurance you or your client needs?
Yeah, that's another really important question. And before we kind of jump to that, like you said, there's a lot of negative information out there. I mean, you have some advisors that refuse to sell any insurance. And from my perspective, I'm like, well, that means I'm going to have to recommend this anyways. And I'm going to have to hand them off to someone else who might upsell them. I would rather be the one who's facilitating that. And then you have other advisors who like basically build their entire financial plans, if you can call that, for their clients around insurance products, right? And so you have these ends of the spectrum, and TikTok and Instagram say all these different things. You hear people that say buy term and invest the rest. We know that is great, but it's also harder to do that in practice. So yeah, what kind do we need? And let me back up. That's why I do this in the context of a financial plan, because I can't have one call with someone and say, hey, yeah, you should buy $1 million policy. I don't have enough information. I need to have their documents. I need to see what kind of assets and liabilities they have. I need to see their goals. I need to know about their family. And that allows me to then make that kind of recommendation. And then we start talking about what kind of insurance. Now, like you said, there are two just big picture categories when it comes to insurance. The first being term, right? This is one that starts when you pay your first premium, and then it lasts for X amount of years, okay? 10 years, 20 years, 30 years. And some might allow you to convert to permanent. If you don't, then that will expire at the end of the 30-year period. And the reason that we use that is because it's simple and it's often more affordable. Now, the downside, or at least the reason it's more affordable, is because you're putting money into a policy that you might never use, right? And so that, can be a tough conversation where it's like, yeah, I'm paying X amount of dollars a month and I might never need this. And the way I talk about this with clients is, that's great. That means you're alive, right? We don't want you to have to use this, right? It's
just like car insurance. You have it and it sucks that you're paying for it if you never use it, but do you really want to use it? Yeah.
Yeah, exactly. So that's just big picture term insurance. And the other is permanent, right? Permanent insurance is self-explanatory. It's permanent. It will last your whole life as long as you're paying the premium. Some have, maybe you can pay it for 15 years and then it lasts for the rest of your life. Others you're paying the whole time. But it's more expensive because it offers lifelong coverage. And sometimes there's a savings component to it. Maybe it's linked to some kind of index, or you can draw from it in certain situations by taking a loan. And when it comes to this, because it's more expensive, we look at these only for pretty specific situations. So maybe someone with a large estate and they're looking at a huge tax bill upon their death. We could set up some kind of permanent life insurance policy to help pay that expected tax bill so that their estate isn't being eaten up by taxes and their heirs are inheriting less. Sometimes it's talked about in business succession planning and other kind of high net worth tax strategies. And sometimes, and this isn't a strategy I use, but I know advisors use it for maybe a different retirement bucket. Personally, I don't use that just because it's such a long policy and you're not seeing a ton of growth on these, especially in the early years. It's pitched as kind of a bond alternative, but I personally don't want to invest in bonds for 30 plus years. That's not really my philosophy. So long story short, those are the differences between, term and permanent. And if I were to just summarize it, for most people, start with term and only add or use permanent when the strategy calls for it, not just because someone's pitching it to you as being your own bank.
Yeah, that's a good point. So term benefits, it's cheaper. You can get a lot more insurance for a lower premium. Mm-hmm. And so you can get it when you're young and maybe you don't have a lot of, income to buy a permanent policy. The downfall is it does expire. So that means you either die and that sucks. And then, but I guess your insurance policy pays out, or you live and then your policy lapses and you never were able to benefit from the premiums you paid in. So knowing that is a huge drawback for term. How do you determine how long to establish a term policy for, knowing that eventually it's not going to be there?
Yeah, that's a really good question. So the way we'll look at that is seeing term as a bridge between the point where you need that to support your family if you were to pass and being self-insured. By self-insured, I mean you have accumulated assets and reduced your liabilities to the point that if you or your spouse were to pass, it would not drastically decrease your lifestyle or derail your goals because you have the assets to cover your expenses and fund your retirement, your education, whatever it might be. So it really just comes down to math. We'll say, okay, based on the savings rates that we're using right now, because we'll have built a cash flow plan, and we know what accounts we're funding, expected growth rates based on historical averages, then we'll say, okay, at this point, maybe it's 20 years down the road, you should be at a point where you're self-insured. And so we'll get a policy that's about that length. Now, with that said, I would rather be overinsured and have a little bit more than I need and have it for a little bit longer than I need than the other way around. So we're going to use very conservative estimates. Maybe a certain portfolio would historically spit out 8%. Well, we'll run with maybe 7. Okay. Just to say this is the kind of conservative estimate that we're using when it comes to projections, right?
Yeah, that's perfect. And then following that up, well, so now we figured out how long. How do you determine how much?
Yeah, that's a good question. And I use a tool that helps me with this discussion. It's within our planning software. And what I'll do is I'll go in and, we talked about jumping into it, but I think I'll just talk high level about this to keep it concise, if that's okay.
It's a great system though.
It is a good system. And the reason that we use it is because we'll have within the plan their income now, the income needed in retirement, Social Security estimates, all their assets, all their liabilities, all their goals, such as education, new car purchase, et cetera. And I'll go in. Taxes, yes, we'll have their tax rates, whether their accounts are pre-tax or Roth.
Because a lot of people don't think about it, but if you're married and joining incomes, you share the burden of taxes, and your tax breaks are higher, meaning you can make more money and get taxed at a lower rate. So once you lose a spouse, your tax rate just instantly went up. So it's big too.
There's a lot that goes into that. Now you're filing a single, and it's your income might be taxed at a higher rate than it was previously, even though your income hasn't gone up personally, right? And so when we're running these numbers, we'll look at, okay, and this is a conversation we're having. Okay, someone passed, right? Now we need to look at income replacement. How much will you need as a spouse to continue with your lifestyle, and how long do we need that, right? And
let me pause you right there, Skylar, because I'm curious how you bring this up, because a lot of people get squirmish when they talk about death, right? Totally. Especially when you're bringing it up with clients. So how do you bring up death to a couple sitting right in front of you?
That's a really good question. And this is one of the harder parts of being an advisor, because you're talking about some of the most vulnerable aspects of people's lives. And one of those is preparing for the unthinkable, right? I'll tell a story, and this kind of helps lighten things up. If I can say it when I talk with clients, I'll tell the story about when I had this conversation with my wife. Because I'm an advisor, I think about numbers and math and whatnot. And I went home, and my wife and I were having dinner, and we just got married. And I told her, hey, I'm going to get a life insurance policy. That way, if I were to die, you'd be taken care of, pay off the mortgage, and have some income. And she almost started crying. And she's so sweet, right? Like she just, for her, all she heard was, my husband died. and in my mind, I'm just thinking about like practicality. Like I want to make sure she's taken care of, et cetera. And so that actually transformed how I have these conversations with clients, is because oftentimes, and it's not always the wife, but a lot of times the wife, it's like, ooh, like that is so hard to think about. And, maybe, and for the husband as well, of course. But just in my conversations with clients, the husband's like, yeah, I just need the policy, like whatever.
Yeah.
And so anyways, I usually bring up that story, and I'll say, look, I know this is a very difficult conversation to have, because it's not just math that we're talking about. We're talking about your lives together. We're talking about your dreams. We're talking about the unthinkable, right? It's hard to imagine a worse thing that could happen in your life. What I want to do as your advisor is make sure that it is not harder than it already has to be, or that it already is going to be. And so we're going to have this conversation. You can stop me if you'd like and ask questions, or we can move along if you need to. But what I want to do is make sure that we have this covered, and then we can go from there and build the rest of your plan and not have to worry about that because we've already taken care of it. And that usually helps, alleviate it. The story, we'll kind of laugh because they relate to it. Like, oh yeah, this is a hard conversation. And then we can, talk about numbers and try to disassociate from the hard truth that we're looking at. Right.
Yeah. Perfect. Well, thank you for sharing. Yeah. That one's a tough one.
It is totally. Okay. So going back to how much. So we're looking at income replacement. And that's just simple. Hey, maybe for some people expenses will go up. Maybe there's a stay-at-home spouse who's taking care of the kids and now you're going to have to pay for childcare. Expenses might actually go up, right? For others, expenses will go down a little bit. So we'll talk about that, right? Then we'll look at debt payoff. So maybe some student loans, mortgage. You could factor in and say, hey, I don't want to pay off the mortgage. I just want to have income to pay the mortgage. But for most people, it's like, I just want to make sure they have a roof over their head, bare minimum. We want to pay off the mortgage. And I tend to echo that. And those are the two things we're looking at. And then basically doing the math to say, hey, how long do we need that to cover these things? And still reach your goals of retiring at X date, paying for college in this amount, and then living this kind of lifestyle for the remainder of your life.
And what have you found in running these needs analysis, we'll call them? Mm-hmm. How much life insurance do you need? When you run it, paying off those debts versus not, do you see that you need more insurance, less insurance? Is it the same?
Yeah, that's a good question. I'm going to be completely honest. I usually don't run it looking at not paying off the debts because almost every single conversation I have, they are adamant that they want to pay off the debts. And so if that's the case, then that's what we look at. I can imagine that it would be, that's a good question. Actually, I'd have to go look at that.
I would think with the time value of money, that you would need more in a life insurance policy to pay off debt than if you were to just assume the payments and let the right opportunity cost.
Right, because it's a lump sum going in rather than letting it grow.
Which then aligns with what you were talking about earlier on taking the more conservative approach with life insurance, because it's better to run it with paying those debts off if you need a higher policy to do so. So that way, and then that way, if the event happens, they have the option to pay it off or not.
Yes.
Versus if you don't get enough, now maybe they can't pay off the debt and have the same probability of success on their financial plan.
Yeah, exactly. No, and that's a good point. But as I said earlier, like I would rather be a little bit overinsured than leave my family underprotected. And
For
so
sure. Absolutely.
that, maybe we got them a little bit too much. Well, I don't think your spouse is going to be complaining if, she has a little bit of excess or he has a little bit of excess in their taxable account now. Like that's probably not going to be a complaint that comes up.
Perfect. Okay, so we've done the calculation and figuring out, how much income are we replacing? You mentioned childcare, college, right? So in some cases, you have just the husband working, and some you have just the wife, and in some you have both. Mm-hmm. My wife and I, for example, we both work, and we have no kids. So our need for insurance is definitely different than someone who's a sole breadwinner. And right, because for us, yes, we go down to a single filer bracket, but we also go down half our income. If you're the sole breadwinner and you were to lose your spouse, you still have all that income, and your taxes just went up.
Yep.
Plus you have the childcare, expenses that could go up. And so, all things that it's really helpful to sit down with someone, hopefully a financial planner who's not just doing this in in isolation, but against your whole plan to say, okay, let's look at all these different scenarios that we can make sure that we cover for the lowest denominator. And in that way you're well off.
Yeah.
And so do you ever have a client come in and say, hey, I know we need to talk about this. I don't know how to bring this up with my spouse. Do you ever have clients have a hard time talking about this to the other person?
Yeah, absolutely. And the way we'll do that is say, hey, look, this is going to be it is a difficult conversation because of the nature of what we're talking about, right? But you have to think about it from the big picture. Would you rather have talked about it and had that difficult conversation and planned ahead versus the unthinkable happens and you never spoke about it? Which pain is going to be worse, right? Your spouse having to deal with your loss plus a massive financial burden, or a tough conversation, getting coverage, and then moving forward, knowing that you are protected, right? And so the way I recommend people talking about it with their spouses, starting with their values, not just the numbers. Like, hey, how much money do you want if I die? Like, that's not the kind of way you start the conversation. It's hey, what do we want life to look like, or what would you want life to look like if one of us wasn't here? And then you try to remove the emotion from it by anchoring the discussion in the protection and the responsibility that you feel towards your family. And then you want to be able to share things openly. And I think this is part of a healthy marriage. It's like, what would be hard for you financially if something happened to me? And then we can start to have that conversation. And that's where it starts. Have the conversation.
You know what opens up when you ask that question? How do you look at life? Like if the other spouse wasn't there. I can't tell you how many people, especially for those individuals that live out of state from family, live away from family, the first thing they do is move back home.
Yeah.
Right. So now you have this move that you should plan for in that life insurance analysis to say, okay, like, are we selling and downsizing, or are we selling in a rural area? We're moving to a city and the cost of housing just went up.
Yep. No, 100%. Especially if you have kids, it's like, I'm going to need help from my mom or my grandparents or whatever it might be. And you realize you got to move somewhere. Okay, well, let's talk about what that would look like financially, and then that'll influence our decision.
Perfect. Common mistakes that you see with insurance. I'm sure you see quite a few.
Yes, absolutely. Waiting too long is the biggest one, because rates go up as you get older, right? And maybe you're in your 20s, you're healthy, you wait till you're 40, maybe there's some health issues now. Rates are going to go up based on that. And so it's better to start young, right? Like I have clients that are a few that are in their 20s, and we get them policies, recommend them policies, and often a little bit more than we even project they need right now, just because they're young and their rates are lower at this point. The other one is saying, hey, I'm just going to get enough. Like I'll just, I have some through my work, and then I'll, pay off the mortgage. And so I'll get a small policy. Well, that's better than nothing. We're not planning for actual needs, right? We're just covering the basics. And again, better than nothing. But I think there's a better way to go about it, which we've talked about today. The other big one, and I get this a lot, is, I have insurance through my employer. It's like, okay, let's look at that. First of all, it's tied to your employment with them. Are you planning to work with them for the next 30 years? I don't know. Okay, if you got another job, would they offer the same kind of coverage? What about in the interim, right? What if you lost your job? Those kinds of conversations. What if you start a business, right? There's all these scenarios.
That one's huge. And like, think about terminal illness. And right, that path isn't like, I'm alive, now I'm dead.
Yep.
That path is, I'm alive, now I'm very sick, I can't work.
Yep.
And then I pass away. And so you might be losing that coverage that you have at the time you need it the most.
Exactly. Because it's, that is, I don't know the statistics, but my guess is that's the most common scenario, is that there's some kind of terminal illness. You're not able to work as you had previously, and you lose that coverage. And so, the coverage is often not as much as you would otherwise need, right? They're not offering you as much as you might.
Like 2 times salary, right?
Yes,
oh, great.
exactly.
Like we're taking care of for 2 years.
Yes.
The other thing too, I don't know if you've noticed, but majority of the group plans, as a matter of fact, there's not a group plan that I've looked over that hasn't been the case. They're all age banded. So every 5 years, your premium goes up that you're paying for. So you're not locked in at a low rate.
Yep.
And if you're healthier than average, then you're getting pulled up to the average on your premium.
Yep. And you could go get a preferred rated policy, and the premium won't change on that. So that's another big one that I see. I've seen a couple, where people come to me with policies that they were clearly just sold. It wasn't a planning conversation. It was just a sale. And so we'll have to plan around that. And then the other one is not updating your beneficiaries. So this is like, good, you have the insurance, but you also want to make sure that your beneficiaries are up to date on those. And so as part of our financial planning process, we review those every few years.
Yeah, perfect. And going back to the policy that someone was sold versus one that they need, that we see a lot with the permanent insurance, right? Yes. And that's where it gets such a bad rep, is because it's used as an investment vehicle. When I was 25 or 26, I can't remember. But I was flying tours over the Grand Canyon, helicopter pilot, life insurance on your own, super expensive.
Yep.
And I was I wanted to start saving. I wanted to start investing. So I was approached with this life insurance product. And as you can imagine, the premiums were astronomical.
Yep.
So I looked at it and I'm like, well, it looks like this isn't making me money until like year 4. Yep. And it's a lot of money to put towards to it. And they're like, well, yeah, but you'll be insured. I'm like, yeah, but it's just my wife and I, and we don't have kids. And she makes more money than I do right now. So none of this is adding up. I get maybe I need some insurance. But I thought that the only way to invest was through this policy. Looking at the table, I was like, can I just put in the first 4 years so I can jump up to line 4 and start making money right away? Like that's how I looked at it. Right? Not even thinking about endowment contracts and how you can't put too much of the premium towards, into the policy. And that's, for another discussion. But common mistake is buying insurance thinking that's how you invest. And it's not. Those are two separate things. There's investing, there's insurance. And they should all be, if done separately, you can tailor those to fit your needs way better than if you do it together.
Yeah, no, I couldn't have said it better. So as far as just wrapping this up, big picture takeaway, like, don't overcomplicate this. For most people, starting with term is a great place to start. Talk about this with your spouse. It's a tough conversation, but it's better to have that conversation than not have it. Okay. look at it as an act of, I mean, really, this is what it is. You are showing that you love your spouse and your children and your family by choosing to have this tough conversation rather than putting it off, right? And so that's a good way to help think about it. And then if this is something that's on your mind, it's definitely worth talking to someone who's doing financial planning and doesn't just have like a plethora of products to sell you. Work with a planner. And if you don't want to work with a planner, like I said, don't overcomplicate it. Start with some term and then go from there.
Yeah, if you want a product that you don't really need, I have 4 sets of tires in my garage now that if anyone wants them, I'll give them to you for a good deal.
I'm not taking you up on that, but someone might.
Awesome, dude. Well, Skylar, thank you so much for breaking this down. Very helpful. There's a lot of information out there on life insurance. So if you found this helpful, like and subscribe. And yeah, next time we'll be chatting about mortgages and if you should pay your mortgage down early or not.
Awesome. I'm excited. Thank you, Benton.
Okay, you're welcome. Yeah, we'll see you, man.